One of the reasons my clients like to work with me is the education process I take them through as their Bank on Yourself coach. The most important concept I teach everyone is what I'm going to show you today. This is going to be your dollar diagram. And using $1 to keep the math simple and easy to follow, I'm going to prove to you that there's no such thing as paying too much premium into a properly designed Bank on Yourself plan. Let's say it's the end of the month and you've paid all your bills and met all your financial obligations, and you still have $1 left over in your bank account. Remember, I'm using the amount of $1 to keep things simple. We call that extra money discretionary income. You can either spend that money or you can save it. Today you're 43 years old. Let's assume you live to be 90 years old. And let's also assume that you put that dollar of discretionary income into a Bank on Yourself policy, paid up additions rider today. That would be the same as saving it, right? From today, age 43, until you turn 90, that dollar of premium is going to grow safely and reliably to about $10 in cash value. This $10 figure is based on how much time your money has to grow before you reach the age of 90. Now, what would happen if you didn't pay that dollar into your policy? What would happen if you spend that dollar of discretionary income today instead? It's gone forever, right? You've spent it on something and you will never see it again. What else is gone forever? That $10 you could have had cash value to grow in that paid up additions rider if you put the dollar in there today instead of spending it. But suppose you really need to buy something and that's why you want to spend the dollar instead of save it. As your Bank on Yourself advisor, I'll remind you that you can always borrow that dollar from your policy on a loan basis and then pay that dollar back to your policy over whatever period of time you decide is right. So let's say that instead of spending the dollar, you put it into your paid up additions rider where it can grow for the rest of your life. And after you put the money into your paid up additions rider, you borrow it back. And let's say you decide to pay that dollar back over 5 years. Remember, we're just using $1 as a concept. It works the same for $1,000 or $10,000 or $100,000. But we'll stick with the dollar. At the current loan annual interest rate of 5% simple interest, the total amount of interest you would pay on that dollar loan over the 5-year period is 13 cents. After you pay that dollar back, you can borrow it again. So you do, and you pay it back over another 5 years at 5%. Your interest cost again is 13 cents. You can recycle that dollar in and out of your policy on a loan basis as often as you want for the rest of your life. But let's say that after you've borrowed the dollar and paid it back 4 times, you want to start using your policy for tax-free income. For those 4 policy loans of $1 each, the total amount of interest that you would pay would be 52 cents. That interest, which is paid to the insurance company's general fund, eventually benefits you, because as your cash value grows by a guaranteed annual amount, you also receive any dividends that the company pays. And dividends are based in part on the interest the company has received on policy loans throughout the year. In fact, your policy cash value continues to grow as if you've never touched it. That dollar you paid in premium grows to about $10 over your lifetime. So let's subtract the 52 cents from the $10 of cash value. After using that dollar for all of those years, borrowing it and paying it back over and over, you would still have $9.48. So here's a question for you. If you had a plan, your own financial system, and for every dollar you put in that system, even after borrowing that dollar and paying it back with interest 4 times over your lifetime, you still end up with $9.48. How many dollars would you want to put in there? As many as you could. With that answer, haven't I proven to you that there is no such thing as paying too much premium? You've seen the proof for yourself, correct? Now, keeping that in mind, let's talk about a more realistic example, a big ticket item like a new car, a nice new car. Let's assume that car will cost you $30,000. You might want to spend more or less than that for a new car, or you might want to finance some other big ticket item. It doesn't matter, it's up to you, but I'm going to use the purchase of a new car as an example. And we're going to assume that you've funded your paid up additions rider to the extent that you could borrow $30,000. Over your lifetime, that $30,000 is going to grow reliably and safely by a factor of 9 to $300,000 or $280,000. You take a policy loan for $30,000 and you go buy the car with cash. By the way, because you're paying cash, the dealer will give you the pink slip. The bank or dealer won't have the pink slip, you will. And because you're paying cash, you may be able to get a better price from the dealer. Now you need to decide how you're going to pay back your loan. Let's assume you need to take 8 years to pay back the loan. Okay, well you could get an 8-year loan from your bank or your credit union, or could you get an 8-year loan from the bank, credit union, or from the dealer? Of course not. But this is your plan, and you decide how you'll pay it back and when. So at the simple interest rate of 5% per year, an 8-year loan payback will have an interest cost of 22 cents on the dollar, for a total of $6,600 interest on the $30,000 car loan. 10 years later, it's time to buy another car. You buy another $30,000 vehicle and finance it the same way. That will cost another $6,600 in interest. Let's assume you buy one more car over your lifetime for a total of 3 cars financed through the Bank on Yourself plan. Total interest for the 3 cars purchased would be $19,800. Subtract that from the $300,000, and the $30,000 grew over your lifetime. That leaves a cash value of $280,000 remaining in your policy after 3 $30,000 car purchases using policy loans that you pay back with interest. What did the 3 cars cost you? 3 times 30,000 is 90,000. That's what you paid for the car. But after paying back the loans with interest, you netted $280,000 cash in your policy. So here's another question. Knowing all of this, why would you buy a car any other way? You wouldn't, because you have your own financial system. You should use it. You should use the loans feature, and you should let your money grow in the policy while you are making those major purchases. Another important question. Why would you want to keep any of your money in someone else's bank and let them get the growth on your money? You wouldn't. You have the best financial system on the planet, and you want to put your discretionary income, your extra money, into your policy as a premium and let it grow over your lifetime. You want to pay as much premium as you can for as long as you can. I've shown you there's no such thing as paying premium. One more thing. If you're already paying as much into your policy as you can, and you still have money you want to put in a Bank on Yourself plan, simply start another policy.